Now, pension freedoms shattered the pension landscape in 2015 when the then Chancellor stood up in Parliament and said that we would no longer have to buy an annuity. What's more, we would have full control and full choices about how we could spend our own pension money in our retirement. So if you had retired in 2015 with £100,000 in your pension fund, what would be left? Half? Nothing? What about your original £100,000 pension fund value? Now, don't forget, in the last 10 years, you would have had to have endured a decade of withdrawals, runaway inflation, the cost of living crisis, the pandemic, the war in Ukraine, stock market volatility, a stagnant economy, and the highest tax burden since 1948. So would our playing it safe paid off? Or did bigger withdrawals lead to a financial disaster and left you with nothing except sleepless nights? So in this week's video, I'm going to be building on the fantastic work by Fidelity, which was published just last week, and the results may change how you look about your own retirement. So welcome back to the Personal Finance Crew. If this is your first time, a very warm welcome. Hi, my name is Simon, and I'm a chartered financial planner with decades of experience helping hundreds of clients and their families prepare well in advance for their retirement. Now, on this channel, we all know that money matters, so let's make money make sense. Well, to answer that question, if you had have retired in April 2015 with 100% exposure to equities and you followed the 4% rule, and by that I mean you withdrew 4% of your fund, or about £4,000 each year, and increased that a little bit by inflation, you would have £189,000 left in your pension fund. And that is almost double what you started with. Now, before you have a go at me in the comments and tell me that 100% equity portfolio is way too risky for someone who's about to start their retirement, if you had a 60-40 portfolio, that's 60% equities and 40% bonds, you would still have had £158,000 left after that 10-year period. Now, before we get into this video, I wanted to say a very big thank you to Ed Monk at Fidelity, not only for creating this research, but also for his valuable insights about income withdrawals. And I'm going to link his research to what inspired this video in the description. Now, the ability to draw down from your pension has been around for longer than you might think. In fact, this has been allowed since 2011, but you had to prove that you had a minimum secure income, and that would normally have come from a final salary scheme, your state pension, or perhaps even an annuity. Now, the minimum income requirement was set at £20,000 a year, and this was later dropped to £12,000 a year in 2014, and then it was finally abolished when pension freedoms came into effect in 2015. Now, I remember when George Osborne stood up in Parliament in March 2014 and announced that no one would have to buy an annuity again. He also vowed to scrap annuities in a major pension shake-up, and that left the £14 billion annuity industry absolutely reeling in shock, and it left them in complete disarray. But the much bigger question was, can we be trusted on how we spend our own money? Now, since then, income drawdown has been chosen by about 90% of pensioners, and last year, 885,000 pensions were accessed for the first time, and that's a 20% increase from the previous year. Now, income drawdown, as you well know, gives us unprecedented access to our pension savings, and that level of control and flexibility naturally is going to come with a high level of responsibility too. Now, in this research, a hypothetical person retired in April 2015 with a £100,000 pension pot, and they would have been one of the first to enjoy all the pension freedoms and all the choice and all the uncertainty that came along with it. Now, to reduce the risk of running out of money in retirement, they followed the basics of the 4% rule, where they took 4% withdrawal each year, and then they increased that by 2% each year to allow for a little bit of inflation protection. And they also had 100% equity stocks and shares portfolio. Now, this was a bold approach, and it could have been called measured recklessness, as they knew that a higher level of risk over the long term was likely to provide them with higher returns and could make the pension pot last a little bit longer. That means they would have withdrawn £47,799 over the 10-year period. And at the end of that 10-year period, they would have had a pension value of £188,977, which is absolutely incredible. But it wouldn't have been plain sailing though, as this portfolio had significant volatility, especially in the early years, and it went to a low of 81,660 in February 2016, and that was likely to be as a result of the Chinese market crash as well as global fears. Now, as you can imagine, that would have given this pensioner a lot of sleepless nights. So whilst a high-risk portfolio can generate stronger returns, it can come with whiplash volatility, and clearly that is not suitable for everybody. Now, in this table, you can see what effect high withdrawal rates of 5%, 6% and even 7% had on this portfolio. 5% withdrawal rate provided income of £59,749, and at the end of the 10-year period the fund value had increased to £169,809, but it hit a low of £80,771 in February 2016. Now, a 6% withdrawal rate provided income of £71,698, but the fund value had then risen at the end of the 10-year period to £150,642, but it hit a low value of £76,537 in March 2020 at the beginning of the pandemic. Now, a 7% withdrawal rate provided income of £83,648 and had a fund value at the end of 10 years of £131,474, and that hit its lowest value of £71,925 also at the beginning of the pandemic in March 2020. Now, have those results come as a surprise to you? As it certainly didn't feel like the golden decade of investment performance to me. Let me know in the comments below. And whilst you're there, can you please hit the like and subscribe button so we can continue to grow the channel? And of course, don't forget the notification bell so you don't miss next week's video, where I'm going to explain your other retirement income options, and I'm going to rank them in order according to their advantages, disadvantages, risks, and of course the overall costs. Now, for those of you that feel that a more realistic approach would have been a 60-40 portfolio, this could be deemed or considered calculated caution, but the results are just as surprising. Now, obviously, as only 60% of the portfolio is going to be exposed to stocks and shares, the final pot size is going to be lower, but the overall journey was a lot smoother and caused a lot less stress and anxiety overall. Now, don't forget, this pensioner retired in April 2015. Now, a 4% withdrawal rate had a fund value of £157,892 at the end of the 10-year period, and it hit its lowest value in August 2015, just 4 months after they retired. A 5% withdrawal rate would have provided a fund value at the end of the 10-year period of £141,922, and it hit its lowest value in August 2015 of £89,845. A 6% withdrawal rate would have had a final fund value of £125,925 at the end of the 10-year period, and that hit its lowest value of £89,845 again in August 2015. So with a lower risk portfolio, taken a withdrawal rate of 7%, that would have given you income of £83,648 over the 10-year period. And at the end of the period in January 2025, you would have had a fund value of £109,983. So just let that sink in for a minute. Now, I know that a drawdown strategy, whilst attractive, is fraught with emotional challenges, especially during downturns and volatility, which we've all seen and experienced over the last few weeks. In this example, there were considerable and significant falls in the fund value just 4 months after this pensioner retired, and it would have been very difficult indeed to stay the course and to control their emotions and stay invested, and more importantly, to stick to the plan. So let's dial down the risk again a little bit, and I'm going to look at the comparison between a drawdown approach and an annuity approach. Now, whatever approach you decide to take, this is going to depend on your risk tolerance, your goals, and if you're happy to miss out on potential investment growth as well as losing some control of your pension fund. But as a general rule of thumb, a retirement should be considered as an investing period of 20 to 30 years or more, and that might match a long-term investment plan. Now, with that in mind, you could consider a level of investment risk, and this research highlights that those who did embrace the risk and who managed to control their emotions were rewarded with substantial growth despite taking regular incomes which were rising a little bit with inflation. So if this pensioner had used their £100,000 pension pot to buy an annuity in 2015, it would have provided a secure income of £5,804 a year. That would have remained level throughout those 10 years, and that would have slowly started to lose its buying power due to inflation over that 10-year period. Now that works out to be an annuity rate of 5.8%, and there's no investment risk, there's no fees and charges, and there's no uncertainty, and that's going to allow you to plan ahead with a lot of confidence. Now, interestingly though, I did a very similar quote to this research this morning, and a £100,000 annuity would provide a guaranteed and secure income of £7,425 a year, and that works out to be an annuity rate of 7.4%, with no investment risk whatsoever. So does that change your mind at all? I mean, a secure and a guaranteed risk-free income of 7.4% for life. Let me know in the comments below. So what have we learned from the last 10 years and from this research which we can possibly apply to the next 10 years? Well, number one is going to be diversification. So make sure any investment portfolio that you do have is globally diversified and matches a level of risk that you're willing and you can afford to take. Number two is obviously stay the course and control your emotions. Have a plan, stick to it, and focus on the long term. And finally, you don't have to have a one-size-fits-all approach. You can mix and match as you see fit between income drawdown and maybe annuities as well. So in this research, they've used various withdrawal rates, and that's really important to give you an idea of how your pension fund could be depleted over a 10-year period. I've linked another 2 videos in this series, and one video is about why we shouldn't use the 4% rule, and another is on the importance and the value of our state pensions. And just because we've got a 35-year track record with national insurance, that doesn't automatically guarantee that we're going to get the maximum state pension. So thank you so much for watching to the very, very end. As always, thank you for your time and for your patience. I'm going to see you all again next week.